Good wishes to all. In this video, we are going to discuss about the concept of cost control, elements, techniques and advantages. Cost control is a practice of identifying and reducing business expenses to increase profit. Nowadays, managements are facing problems of survival because of acute competition. Only those organizations can meet the competition and have a hold on the market which are in a position to keep their cost minimum. Cost accounting can be instrumental in this regard by eliminating all inefficiencies and wastages by exercising cost control. Cost control by management means a search for better and more economical ways of completing each operation. Cost control is simply the prevention of waste within the existing environment. This environment is made up of agreed operating methods for which standards have been developed. Standard operating methods in the sense they have a definite procedures. For an example, if you take and turn the food container, the ingredients of the contents you can able to see. It could be expressed in terms of, for an example, protein 3.00%, fat 1.23%, etc. like that. If you watch the making process, they will clearly tell you how many minutes it should be cooked and when it will be transferred from one process to another process like that. This is called standard operating methods. If the management strictly adhere these procedures, it can avoid wastage and attain their goal efficiency. Definition of cost control. According to ICMA, cost control as the regulation by executive action of the cost of operating an undertaking, particularly where such action is guided by cost accounting. Here, the term regulation and executive action indicate conscious attempt of regulating of cost on the basis of predetermined ideas about what cost should be. It is only when costs are predetermined, that is, a system of standard costing is in operation, that cost control measures can give their best. Thus, cost control aims at reducing inefficiencies and wastages and setting up of predetermined costs and in achieving them. Next, elements of cost control. The first one, cost control is exercised through setting up of standards or norms or targets. Here you must understand the term standard. It is a predetermined cost which determines what each product or service should cost under certain situation. Then select a yardstick for measuring the standard. Then ascertain the actual performance. The fourth one, it should compare the actual performance with the standard, analyze the differences between the actual and standard and find the reasons for the deviation, taking corrective action to eliminate the deviation so that future performance conforms to standards and cost may be controlled to achieve the maximum efficiency. At last, periodically review the standards and revise them in the light of changed circumstances. These are all the elements, or we can say it is a process of cost control. Next, cost control techniques. The first one, material control, is a systematic control over the material at all its stages from the procurement and making of inventories and usage system. Material control refers to the managerial activities relating to giving instructions or directions to ensure maintaining adequate quality and quantity of materials for uninterrupted production process with the objective of minimizing material cost. Second technique is called labor control. The cost of remuneration paid to the laborers are called labor cost. The cost of labor is the sum of all wages paid to employees as well as the cost of employee benefits and payroll taxes paid by an employer. So, the organization has to ensure the manpower quantitatively as well as qualitatively. If it fails to balance these, it will affect the true cost of goods and services as well as profit. When we speak about quantitatively, a cost of accounting system will serve the information relating to the number of employees required to engage in the production process so that management can avoid the situation of excess or shortage of employees. Because if the organization has excess employees, definitely they need to mete out unnecessary expenditure. Otherwise, shortage of employees causes over workload to the existing employees, which leads to increased labor turnover. That means people switch over to other organization. This may cause the organization to incur additional cost to recruit the right employee and a provision of training to them, etc. When we speak about quality, every organization they are striving hard and spending more to retain the quality of employees. On the other hand, they should have an eye on the amount of spend on these employees. Here, I would like to speak about the term CTC. I hope most of you are familiar with this term. CTC called cost to company. It is a term for the total salary or package of an employee used in countries such as India and South Africa. It indicates the total amount of expenses an employer, that is organization, spends on an employee during 1 year. The CTC contains all monetary and non-monetary amounts spent on an employee. So this way, by fixing CTC, the companies are controlling their labor costs as minimum. The next control technique is called overhead control. Overhead costs are the indirect and sometimes invisible costs associated with producing a product or service. Overhead costs are operating costs of a business enterprises, which cannot be traced directly to a particular unit of output. Cost can be broadly divided into two, that is direct cost and indirect cost. Direct cost is that portion of cost which can be directly identified with output or operation. Again, I am telling cost can be divided into two, direct cost and indirect cost. Direct cost is the portion of cost which can be directly identified with output or operation. For an example, material, labor, expenses, etc. On the other hand, indirect expenses are the expenses which cannot be directly identified with output. These are the commonly incurred expenditures such as rent, depreciation on fixed assets, etc. Hence, all the indirect expenses are otherwise known as overheads. Again, all the indirect expenses are otherwise known as overheads. The overhead expenses nowadays represent a significant portion of total cost and assume greater importance for ascertaining accurate cost for pricing and control purposes. Next control is called budgetary control. a system which uses budgets as a means of planning and controlling all aspects of producing and selling commodities and services. Budgetary control is a system of controlling costs which includes preparation of budget, coordinating the departments and establishing responsibilities, comparing actual performance with the budget and acting upon results to achieve maximum profitability. The comparison of budgeted and actual figures will enable the management to find out discrepancies and take remedial measures at a proper time. Next technique is called standard costing. Standard costing is the practice of substituting an expected cost for an actual cost. Actually, standard costing is an accounting system used by some manufacturers to identify the differences between the actual cost of goods produced and the cost that should have occurred for the actual goods produced. As the standard cost is calculated using different statistical measures and the experiences of the management, so with the help of these measures, management can innovate different new ways for producing the product which do not require the same type of procedures and thereby reducing the cost of the company. So standard costing and budgetary control are more or less equal, but they are different. Budgetary control, it is the difference between the actual and budgeted cost. Standard cost is the difference between the actual and expected cost. Next technique is called marginal costing. Marginal costing is a technique of cost accounting which pays special attention to the behavior of cost, which changes in the volume of output. Actually, marginal costing is a technique of costing fully oriented towards managerial decision making and control. The term marginal cost implies the additional cost involving in producing an extra unit of output. Marginal costing is helpful in determining the profitability of different products produced by the organization and different individual departments and different processes separately as well as different cost centers. The next technique is called productivity and accounting ratios. Ratios are a group of metrics used to measure the efficiency and profitability of a company based on its financial reports. Productivity ratio is the fraction of output over input. For an example, labor productivity is the ratio helps to calculate the output per person. Capital productivity ratio is the ratio of output to the input of physical capital. Then material productivity ratio is the ratio of output to input of physical materials. Accounting ratios are familiarly known as financial ratios. Example, you can take a debt equity ratio, quick ratio, dividend payout ratios, etc. These are all the different cost control techniques used by the cost accounting department which serves multiple purpose of the management for decision making and control. Next we are going to discuss about the advantages of cost control. The chief advantages of cost control are, first one, the organization can increase the return on capital and it can increase the profit value with minimum sales, improved productivity with limited resources, it can provide continuous employment to laborers, and it can pay reasonable remuneration to its employees, and it ensures effective utilization of factors of production and resources, then improved credit worthiness, and It helps to maintain